What's up, everybody? Michael Silva here with a very important market brief today. In today's episode, we're going to be covering various aspects of the CBOE options sentiment indicator. Then I'm going to be showing you the SP 500 and the Nasdaq. We'll be quickly discussing the dollar as well. The bulk of the time is going to be spent here walking you through this indicator that I put together on stockcharts.com. Now, this isn't something that I created, but it is something that perked my interest a while back, and I decided to bring it back out just to see what was going on with it. So without further ado, let's go ahead and hop into today's show. All right, welcome back. Right now we're at a chart for the CPCE, which is the put to call ratio, and I'm going to explain its importance here. If you don't understand it, you will, because I'm going to make it very, very simple on another chart, how we can really read to see what the market is going to be doing next. It's an indicator that I put together. I didn't create it, by all means. I did not do that, but it's something that I've seen in the past, and I feel like it's going to be very important here in the near future. So this is the CPCE. This is the options equity put to call ratio. The equity portion, okay, there's three different charts we can technically be looking at. We have the CPCE, that's the equity, and then we have the CPCI, which is the index, and then we have the CPC, which is the total combined ratio. The CPCE, the reason why I show you this is because it's more retail investor sentiment. The CPCI, it's typically above 1, which this is typically below 1. And the reason why that is typically above 1 is because that one is used more by institutional investors that are hedging their bets with puts. So what we're going to do today is combine the two and look at the CPC chart. But when we look at the CPC chart, it's very similar to this. Okay, you have the 1, and then it goes above 1, and then it goes below 1. And it has these spikes. And I was looking at it first, and I was looking at the spikes. It was too hard to read. So what we're doing today is we're going to be smoothing it out and walking you through the indicator on a 10-period moving average. So without further ado, let's go ahead and go to that chart that I just put together. Okay, so here is the CPC with a much shorter moving average. So what this does for us on the 10-period moving average, it allows us to remove these violent spikes. So one, this is basically going to reduce the amount of upticks and downticks, which would mean that when we get into certain ranges, they can be held there for a lot longer period of time. The 1 level is still right here, so the overall sentiment in the market, as you can see, is still very bullish. Now comes into play the green and the red line. These are adjusted because we minimized the spikes. So they go to 0.95 and 0.80. And here is where the indicator gets very interesting. First off, I'm going to go from a buying perspective and then from a selling perspective. Where in this chart is it going to tell us to sell the market? And then where in the chart is it going to tell us to buy the market? Now, what this indicator does not tell you, this indicator will not tell you when it's a good time to get out of the position that it tells you to enter into. We have to use our charting skills and look at the indexes or the individual stocks that we're in to determine when would be a good place to get stopped out at or to exit the position as a whole. Yes, it looks confusing, but let me walk you through it. First off, let's talk about the bullish perspective. So this 0.95 level, when the line crosses above, so when it goes from below it to above it, that is a bullish indicator. However, that is not telling us to buy into the market at that particular time. You need confirmation, and confirmation would mean that the price has to cross back below that line. That would signal us a buying signal. And the reason why it's like this is because we got rid of the spikes, so it's a little bit of a lag time. Let me walk you through this. So when I'm saying it, when the price crosses below it, that is a buy signal. In order to do this, I'm going to go ahead and use a vertical line, and I'll make it green here. So I'm going to go ahead and highlight when the price crosses below the green line. So first off, right here on this chart, we're looking back not that long, but right here would have represented a buy signal. Okay, we had the price cross above it, and then here is when it crossed below it. And notice here on the S&P 500, from this point up to this point, nice run up. All right, let's keep going through the chart. This price crossed below it right here, nice run up as we see, bullish momentum. And now ignore that, yes, we'll talk about the bearish when it came all the way down here in a second. Okay, so right here, it came above it, but this is where it crossed below that 0.95. Where did the price go? Well, the price kind of just went until it hit this other buy signal. Also right here, when it crossed below it just at the end of the chart, that was technically a buy signal. The market really just went sideways right there, not giving us much, but then it gave us another buy signal here shortly thereafter. Okay, so we have established the buy signals. What is bullish on this chart? When the line goes above the 0.95, it's indicating to us, hey, get ready, this could potentially be bullish here to buy here soon. When it crosses below that line, that is the buy signal, according to the options total put to call ratio here. Okay, this is the CPC. This is the overall market sentiment that we're looking at from the total option exchanges. Now, a lot of people have been talking about the stock market crash. Okay, when will there be a crash? Is there going to be a crash? I don't know. But what I want to point out here now is when. The warning sign is when the price crosses below the 0.80, but the sell signal takes place when it crosses above it. So as of this moment, let's go ahead and check it out. I'm going to make these ones red. So the sell signal occurs when the price action moves above the 0.80, not when it crosses below. That's just an indicator telling us that, hey, you know, sentiment might be shifting here eventually, which we saw it shift right actually down under here at July 15th of 2020, and it's been down there ever since. It has not crossed above the 0.80 at this particular point in time. So I'm going to remove that. But what I want to point out here is when it crosses above. So it crossed above right here on June 18th. And then what took place in the market? Well, right there shortly after we saw this dip take place. This was right around that pretty volatile movement from July 16th to about July 18th. We saw that rip down and then kind of a bounce and then more pull to that 3,000 level, which I talked about in previous videos. So that right there was a sell signal, and then we got that pullback. Okay, not some crazy crash. That's not what I'm trying to say here. It doesn't mean that the sell signal means crash. This is where technical analysis comes in, and you know, monitoring your stop losses and understanding how to read charts and where to take profits, managing your trade, etc., etc. That was a sell signal. Let's go back. Right here, it crossed under it and then crossed right above it very quickly. So there's technically crossed above it, and then the very next day, maybe even potentially the same day here, it was the next day, crossed back above it. So right here was the sell signal. Now, this doesn't necessarily happen all the time, but if we paid attention to this previously, you know, in hindsight, the sell signal clearly was right before the market just jumped off a cliff. That was the February crash. Right here as well, the market said this is where you should start getting a little bearish. This is a sell signal right here, and the market kind of went down right here. So you can see a little bit of a pullback, but then it went up before making its next sell signal. So we have an understanding for the most part that when the price crosses below the red line, that is just a warning sign, just saying, hey, keep an eye out now, because when it crosses above, that could be a sell signal. That means the market sentiment is getting way too bullish, which means the contrarian indicator is, hey, we should probably pump the brakes here and start getting a little bearish. Why is this important, and why am I telling you this right now? Well, it's because we got the warning sign here in July 15th. Right there is the warning sign, and the price right now has been pulling back. So the overall market sentiment is just way over bullish right now. Very, very bullish. However, we did see this little spike up right here, which, you know, look at the S&P 500 right below it. We saw the down tick. Okay, so we saw that pullback, but that's nothing yet at this particular point in time because we have not seen the cross above 0.80. So how do you trade something like this when you're trading the SPY, the SPX, you know, whatever it is that you're trading? Well, right there will be a good ideal point, if it crosses above the 0.8 here in the near future, to get ready to, take some of your profits off the table, or hedge your long positions. Now, it doesn't mean that the market's going to crash like it did here in February, but a lot of analysts and a lot of professionals are saying that, hey, this looks like very similar to 2000, where we get these just monster run-ups, huge market caps, gigantic bubble. So by monitoring and looking at this CPC and the market sentiment and watching this indicator here, it could be very, very good for us to ensure that, hey, we need to pump the brakes a little bit when this thing crosses back above it. Once again, not necessarily mean that anything is going to be big and dramatic or take place, but it's been a while since the market has been this bullish, under 0.80. So just so much bullish sentiment here, but yet we're starting to see this uptick right here, which can very well just be the ground shaking for a potential earthquake. I'm going to be bringing this up. I'm going to be following up on the CPC CBOE options total put to call ratio in the near future, and I'm going to be keeping an eye on this crossover of the 0.80 marker. At this particular point in time, from where we are now to where we have been, the last previous indicator was a sell signal. It has not reached a buy signal at this particular point in time. So that said, this whole run up right here, if you just sold everything and got out of the position completely, you would have missed a run up from here to all the way up here. So that's why I stated, and I want to reinstate, that when you get sell signals, it doesn't mean that the market's going to technically crash. It did pull back right here, but what we need to look for is if we do get this cross above the 0.80, that's when we start to hedge. That's when we up our stop losses. And then we look for key levels of support on other charts to determine when would be a good place to buy in. So I'm going to state it again why this is so important. If we get a cross above 0.8, what history has showed us is we typically see a pullback. The overall sentiment is way too bullish, and then it's going to quickly convert to a bearish sentiment, which would, from what we see, bring the market down. Then we would have to go to the SP 500 and the other indexes and look for main key levels of support that the market can pull back to and potentially bounce from. All right, let's go ahead and now look at the S&P 500. All right, so here is the SPX, the S&P 500 index. And as you can see, we had a nice update, up 2%, nice little gap up. This right here is why I titled the video as I titled it in the previous market brief. At least on the thumbnail, I was stating that, there's fear in the air, but the bulls do not care. And the reason why I was saying that the bulls do not care about these 3 massive drop days is simply because there's coming into a large area of support. The market was super overextended. We knew this was going to happen. There was just way too much pressure to the upside, and gravity had to settle in. So what did we see? We saw this rip down, and now we're seeing this little bounce up. If we get a continue, that's another thing. This could be very well a dead cat bounce. We don't know yet. However, what I do notice is that we have a little bit of data right here pointing out this level at 34.24, which is really pretty much the high of today's candle. That right there is a level of resistance. We got this bounce and we got rejected there, and then now we're sitting around this level at 33.97. So right there is going to be the resistance we want to watch out for tomorrow. If we get a gap above it, then I can see us backtesting this as a level of support and potentially heading higher. But if we can't get above this level, this might be just a temporary little bounce here. I'm going to go ahead and zoom in on a closer time frame just to walk you through what we saw going on intraday. All right, so here is the S&P 500 index on the 30-minute time frame, and if you follow me on Instagram, I actually pointed this out ahead of time where I said, hey, it looks like it wants to start breaking this, but it's getting a little bit rejected right here because it filled the gap window. And if we draw actually out a very steep kind of a line like this, what you can see is, a falling wedge pattern within these days of trading. And then if you look at the RSI was printing a positive divergence. So yeah, we broke above that, and then this was the level of resistance right here, and that obviously was the gap that we're seeing that was cleared on this gap down. So the last 30 minutes of trading, however, we got a real big push to the downside. And what I was saying is you can trade into the momentum to the upside if we get a break above this, because that right there could make sense as a breakout, because I can draw in another extended ray right here, which I drew out on my Instagram, and that was still just a larger term falling wedge. And really, we kind of got above it a little bit there, but ultimately it got rejected and held up at that resistance, and then we got the blow back downwards, which makes sense for me on this particular move just because there's a lot of downwards pressure regardless. The 50 period was sloping down, the 200 period was moving overhead. So let me just zoom in here real quick just so we can see a good idea for a potential bounce opportunity heading into tomorrow. So first off, the resistance is right there. As far as support goes, the level of support that we're going to want to watch is going to be right here. I think this could be into play, and that is 33.80 we can call it, but clearly we had a few bounces right from here, this level, and then it acted as resistance getting rejected as well. Then the other level that I want to mark out is right down here at 33.54, and that's simply because we had this gap window take place and it hasn't filled this gap. So these are the levels I want to keep an eye on heading into tomorrow, because if we get a pullback to here, we might see a little bit of a bounce. You can have a tight stop loss, or if you get a pullback to here, you can have a tight stop loss and potentially play the bounce from that level. However, if the futures market just runs this thing up and we get a gap above here, we might be able to just simply one, play the bounce and have a stop loss from there, or if we open up with this in this channel and we keep on going sideways like this, that might create a launch pad for ourselves to just play a breakout candle move and have a tight stop loss below that. So this kind of stuff, I love these type of patterns and this type of trading because it offers up just a lot of different opportunities when volatility is really setting in. But these are the levels on the 30-minute time frame that my eyes are on tomorrow. The CPC, as I mentioned already, that is a big indicator for us that we're going to be monitoring here in the near future. That sell signal looks like it's going to be coming here in the near future, but we'll see that can stay in that area for quite some time. Now let's just peek at the VIX and what that's doing. Here is the VIX, but it's on the 15-minute time frame, and the reason why I wanted to show you this on the 15-minute time frame is it's actually forming another falling wedge that it's kind of breaking out of right here. So something to monitor very closely, because if this does start breaking above, this might be that whole buy the dip moment where we might potentially see more downwards pressure on the S&P 500. Now when I go into the daily time frame, I mean, it tells somewhat of a different story. We have the breakout of this falling wedge, this gray box down here. That's the gap window that we haven't filled yet, and I still personally believe at some point we will fill it. So if the S&P 500 continues to rise, we can see this continue to push down, maybe to the point, I mean, probably with some choppiness to close this gap, and then that might be the point where we start seeing the VIX really skyrocket in volatility. I do think that the VIX will be going higher here within the near future. I don't know when that particular is going to be. I'm not that smart, but our target was almost hit. We said 40 to 45, but the VIX has the potential to reach just a whole lot higher than that when volatility picks up. And right now, in my mindset, I'm a little bit more bullish on things, only because of the fact that we have, one, the Fed speaking, I think, like next week, or coming out with some stuff next week, and then we have OPEX here very soon. If you look at a seasonality chart of the presidential elections, it's typically kind of bearish in September, which September is not always the greatest trading month. But during election months, it gets a little bit more bullish towards the end of the year, where then October you see that pullback take place. So this might be just pushing up into those dates before we see something really big happen. Now, I will say that the VIX right here does kind of look like a bull flag, and I might as well just point it out. You have the pull right here, and then you have it kind of sloping down like so. So this could very well potentially be a bull flag where we might get a break and continuation to the upside. That's also worth monitoring, but you know, it's too hard to make that specific call right here at this particular point in time. Now let's go take a look at the NASDAQ 100. All right, so here's the NASDAQ 100. The McClellan oscillator down here, still negative breadth in the market. Not too surprising. It's been that way since August 17th, and the date now, so almost a month as a negative breadth, and this market still continues to rise. Now, what do we got going on? We broke down from this channel, this rising channel. We cleared, broke down, but now we're seeing that bounce. The bounce, to me, I'm not surprised. I'm not surprised at all. Why am I not surprised? Well, because, I mean, it closed right here on the 50-period moving average and right by the 0.236, which we already mentioned. So a lot of bulls right here already, one, pushed the price up intraday on the previous day, which already shows us bullish kind of signs to say, hey, maybe we should be a little bit careful here. The previous candle was an inverted hammer candle, and that on the downslope move is a reversal type candle. I like seeing a more bullish type candle where there'd be a long lower wick, but this still right here represents that the bulls stepped in intraday. Still kind of means the same thing. And then we saw the uptick. Okay, we see this big move to the upside today in the Nasdaq, almost up 3%, closed at 11,395, basically 11,400. However, what we need to monitor and pay close attention to is this bottom trend line now, because it acted as support. Now it very well might act as resistance. So we got to keep an eye on that. Maybe it might enter back into this channel and we just get rid of this channel altogether. But ultimately, it's in bullish context. We're having this steep pullback, very aggressive pullback, by the way. This right here was a percentage point move of just about, I mean, I'm not perfect on this, but almost, so 12.5%. So a correction by its terms on Wall Street is 10%. So within 3 days, we had a 12% correction in the Nasdaq, which is probably the largest 3-day trading day decline on record. I did see a print there somewhere that said that or said something similar, but the largest 3 trading day decline, a whole correction down 12%. That to me is a flash crash right there. That's a very aggressive move in a very short period of time, basically telling us, hey, volatility is here, volatility ain't going anywhere, and this bubble keeps on kind of just blowing up before something ultimately pricks it, and then we can see some crazy stuff probably take place. Or from a bullish perspective, maybe this thing just gets inflated to, you know, just the moon, and that's also a possibility. But you know, the Nasdaq at $50,000, you got to wonder, like, how much is toilet paper going to cost in a grocery store when everybody's a millionaire? You know, it's so funny. I was thinking about the median price of houses, okay? The median price of houses probably 20 years ago. I don't have a chart of this, but I know that I can Google one and find one, but I didn't prepare that. This is just off the top of my head. But you got to think. So think about your parents or your parents' parents. When they bought their first home, it was probably $30,000 or, you know, $80,000, somewhere around there. I'm in California, so it might be a little bit different, okay? Well, I pulled up a chart a long time ago about the median house in, I don't know if it was California or the United States. I'm not too sure, but $300,000 was the median price for a home. The house that I live in right now, it's valued at like $440,000, okay? We didn't buy it for $440,000. It just apparently just increased a lot within the last 2 years of owning it. What I'm trying to point out here is the median price is just on this huge rise. So if the Nasdaq and the SP500 and all these indexes go to 50,000, do you think that the median house is still going to be 300,000? Absolutely freaking not. The starter home in 20 years is going to be $1 million. My starter home was only $1 million. Like that's just the level of insanity when it comes to these asset bubbles and Fed intervention. When the Fed intervenes with this stuff, it inflates all these prices around us and doesn't allow the market to determine what the best price is. And if you are involved in the housing market right now, if you're trying to sell houses or buy houses, you're competing against just a bunch of other people that are bidding these prices up because the interest rates are so darn low. All right, I am ranting right now. But so we went over the S&P 500. That was important. We went over the NDX. But really, today I just wanted to show you the CPC. I just wanted to touch on these two. Let's go ahead and look at the dollar index. And then I'm just going to say tomorrow we'll go over, or I'll make a separate video on gold, silver, and Bitcoin for another time because I'm running a little bit late here. So here's the dollar index. The dollar broke out of the channel, came down to back test it, and is closed right around there. So we didn't come back in. This might not be a false breakout at this particular time yet. Gold and silver, they did go up. I think Bitcoin went up as well. Typically when you see the dollar go down, you can see other assets like that go up. They kind of have inverse correlations, but not all the time. So don't hold me to that. But yes, so it broke out of the channel. We're seeing a move up into this area of resistance. Still got a lot of work to do. Somebody did point out Michael, thank you, left a comment saying that there was a positive divergence. I didn't call that out, but clear as day right here, right? We have the positive divergence. We had the trend line going down. We had the RSI moving up. We were in oversold territory, which we were mentioning, and it kind of was basing itself out. So these kind of things, when you notice them take place, you get nice run-ups like this, and you can catch that win. Now we're getting the breakout on a little bit of a retest right here. So now we got to just monitor and see if we get a continuation to the upside with some down moves, up and down to make higher highs there, or if this might just be a little fake out to potentially head lower. Like I said, we got a lot of things going on in the next couple of weeks and the next month and the month after that. So just be prepared. There's going to be a lot of things taking place, I would imagine. And I couldn't tell you if that's going to be a bullish thing or a bearish thing because we don't quite know at this particular point in time. That's all I got for you on today's market brief, guys and gals. See you later.